David, I guess what would be really interesting is to sort of, we do a lot of work with accountants, with bookkeepers, and they're certainly a very good source of referral work for us because you guys are on the front line with ATO debt. And I'd be interested to see what you're seeing out in the marketplace, and particularly, I guess, from that ATO specific space.
I think what I'm seeing is probably over three quarters of our clients having some form of debt, um, or not being easily able to meet their obligations when quarters come around. So sort of scrambling to meet their obligations. And I think obviously I've watched a couple of these other videos and we've had conversations and in conversations with other people in the industry. I think it's been a flow-on effect from COVID. Obviously, COVID was a big trigger, but probably what really happened is that the ATO let people get into reasonable amounts of debt before they would take measures or action that would stop that accumulation of debt. So what I'm finding now is that the ATO is being far less forgiving with the quantities, the duration of the debt. And I would say that's across the board. So not even just our clients, anyone I speak to at networking events, friends, family, if they've got small businesses, most of them have some form of tax debt at the moment.
Yeah, look, I think that's right. And certainly, we were dealing, because obviously we're dealing with the ATO every day, all day. And, certainly during COVID, and particularly if I roll back to sort of around March, April, May 2020, when we were in the throes of, well, we were in the beginnings, I guess, of COVID, but certainly the ATO took a policy approach then, which I understood what they did. And I think it at the time was probably the right thing. And that was they were worried about what was going to be the impact of COVID and the pandemic and allowing businesses to, I guess, essentially store cash. And so they were saying, look, keep your lodgements up to date, but at the same time, there's no need to make payments. And we even had clients that had existing debt prior to COVID that we were trying to put into payment plans. And the ATO was saying, no, we're happy to defer all of that. And we resisted a lot of that and actually got as many of our clients as we could into plans because we knew that coming out the other side, there was going to be this mountain of debt. And we know that a $26 billion uncontested ATO debt, 2/3 of which was owing by small business or the SME space, is now a $53 billion tax debt. And that means and it's not just that there are double the businesses that have tax debt. It's not really that. I mean, that is part of the problem. There are a lot more, but the debt sizes are much bigger. Our average tax debt that we were dealing with prior to COVID was around that $400,000 mark. Now it's around the $1 million mark. And that's difficult for businesses that, if they haven't stored the cash, to actually then meet those payments and meet those payments out of cash flow.
Yeah, and obviously I didn't touch on it, but I have an exposure to construction, significant.
Mm-hmm.
I've worked in construction in one way or another, project-based construction businesses for the last 20 years. And I think I read somewhere that construction was close to 20 billion of the 56 billion, something like that. So
Yep.
It's disproportionately reflected in the tax debts. And
Yep.
I think it's only about 15% of industries construction, and we're at 20% of the tax debt. So it's disproportionately high, and at the same time, there's lots of insolvencies. So I certainly feel that tax debt in the space that I'm working in is super prevalent and prominent. So,
And what are the things you're seeing in, let's talk about the construction industry because we do, sort of following on from what you said, yes, they are disproportionately represented, and through no fault of their own, these are really good businesses. But there's been a whole range of factors that we see and we get told about almost every day. But what you're seeing as the main things that are, I guess, affecting the construction industry now that it's making cash is the issue. If cash flow is tight, then ATO debt rises.
yeah, I think part of it is something you can't get around in construction. So even the most generous of builder, if you're a subcontractor, trade services, you are going to have some form of retention, whether it's a cash retention or a bank guarantee. Either one of those will tie up capital. So if you're bank guarantee, you're most likely having some equity in your properties or properties that you may have being tied up to utilize as a guarantee against your execution of a contract. If it's a cash retention, you're literally having the builder hold your cash for where you get 5% back at completion, and then another 2.5% back at completion, and another 2.5% a year later after your defects liability period passes. And what I found is between those two, the inflation cost pressures that we're feeling in raw material, there's a real squeeze in labour. So labour in construction hasn't decreased. Salaries haven't increased the way they may have in other industry, but they certainly haven't decreased. The unemployment rate's not high in construction at all. And I think in some particular roles, it's probably minus, if that's a thing. And as a result, builders and anyone involved in construction is having to retain staff at a time where maybe they may have shrunk or reduced their team size, and it's just eating into profit. So you've got cash out in a retention, and at the same time, you're having to spend more at an OPEX level to keep your teams the way they are on the promise of work to come. So
yeah, it's interesting, David. We've done a lot as you know, in the construction industry. We have seen so many clients where a really big contract, potentially profitable contract, has actually sent the business to us because they haven't had the capacity to be able to, either the contract wasn't as profitable as they thought, or they just didn't have the capital to actually deliver on the project, and then it went pear-shaped, and then they suddenly said, well, look, where can we find some money? So the ATO didn't get paid, and then they've worked their way through the contract, and at the end of it, they've got a $600,000 or $700,000 ATO bill, and thinking, now how do we deal with this?
Yeah, and a lot of that is because the reality is in those situations, the margin actually wasn't there to begin with, I think is what tends to happen. In construction in particular, and in particular if you're a builder, every week where you're not getting the right amount of revenue, which is productivity, your overheads, your fixed labour cost or your fixed preliminary costs, they're accruing. So every week you go over, and most construction projects tend to have a little bit of giving their programs, you're losing money on what your estimated margin was. So if originally you went in pretty tight, by the time you're done and everything is said and done, the margin wasn't what you actually expected it to be. And I think if everyone in the industry priced it at the appropriate rates, the cost to build would be unsustainable. So I think you have some pressure from developers down, pressures from subcontractors up. So if you're a builder, you can, and which is like what we saw, the likes of PBS and ProBuild, really big builders. They were taking on jobs that were a little bit too tight, and you only need one or two things, and that domino falls, and everyone's going to feel it down the line.
David, I think it's been great. So look, thank you for making the time and having a chat, and look forward to continuing to work with you, and hopefully we can both do our parts, as you say, for you to keep people away from us. But if they do need us, then we're here to help.
Thank you very much. Thanks,
Cheers.
Michael. Thank you.